Welcome to my video about the fundamentals of valuing bonds. My name is Dennis Vink and I'm a Dutch professor in finance. We have 4 learning objectives. The first one is to identify the cash flows for both coupon paying bonds and zero coupon paying bonds and to calculate the value for each type. Second, to identify the yield to maturity, which is the market interest rate, for both coupon and zero coupon paying bonds, and to interpret its meaning for each type of bond. Learning objective number 3 is to determine whether a bond will sell at a premium, at par, or at a discount, given the coupon rate and the yield to maturity. Furthermore, to describe the time path the bond's price will follow as it approaches maturity, assuming, of course, that the interest rates remain the same over the life of the bond. And in the last learning objective, we're going to have a look at how the bond price will change as a result of changes in interest rates. Let's go back and have a look at the basic principles of valuation. And this is very important because in this video we're going to value a bond. So let's have a look at the underlying fundamentals of valuation. This is also called the valuation triad, as we've discussed in the previous videos. You need to have a future cash flow, a discount rate, and an appropriate formula to calculate the present value. And all 3 will allow you to compute the value of an underlying asset. In bond valuation, we can already identify that the expected future cash flows are, for example, principal or face value that needs to be paid back to the investor, or coupon payments if we're dealing here with a coupon paying bond. The desired rate of return in bond valuation is called the yield to maturity. Let's look at this table that shows you the underlying asset that needs to be valued: bond, stocks, businesses, and projects. It identifies the future cash flow. Well, for a project and a business, it's the operating cash flow that needs to be added in the appropriate formula. If you want to calculate the value of the underlying stock using the dividend discount model, of course the future cash flow is the level of dividends. And what we just said is that in bond valuation, the cash flow that goes to the investor is the result of an interest payment, which is also called a coupon payment, and repayment of the underlying principal, which is also called the face value of the bond. Let's have a look at the appropriate discount rate used in the valuation model. Both businesses and projects use the weighted average cost of capital as a discount rate in the equation. Okay? Stocks, using the dividend discount model, is using the cost of equity as a discount rate. When we are dealing with bonds, we are going to include the cost of debt in the valuation equation. And the cost of debt is equivalent to the yield to maturity, or also called the market interest rate. Now, looking at the last column, we can see that both projects and bonds have a limited time window. So in other words, the cash flow that's being paid out to investors has a limited time path. The stocks and businesses both have an infinity time window because the underlying cash flow is paid out to the investors until the infinity. In order to understand how to value a bond, we need to get back to the basic formulas of valuation. The first one is the present value of a single cash flow. The second one is the present value of a row of equal or fixed cash flows. In the next few slides, I'm going to use the equation of a present value of a single cash flow to compute the value of a zero coupon paying bond. And I'm also going to use the equation of the present value of a row of equal cash flows to compute the present value of a coupon paying bond. Let's have a look at the present value of a single cash flow first, that we're going to use in this example to value a zero coupon paying bond, which is the investment opportunity here. The zero coupon paying bond is paying us 10,000 euro after 1 year. We need to understand that the zero coupon paying bond does not pay any intermediate payments. The only payment it pays out to the investor is the face value at the end of the lifetime. Now, in this case, the maturity or lifetime of the zero coupon paying bond is 1 year. And its face value that it is going to pay out to the investors in the end of the year is going to be 10,000 euro. Now, the risk of the investment, so the zero coupon paying bond, is 10%. Now, here it is called the desired rate of return, but in bond valuation, the 10% is equivalent to the yield to maturity, which is the desired rate of return. However, we call it the market rate or yield to maturity. So if we fill in the numbers into the equation, we are going to get a present value of a zero coupon paying bond of 10,000 euro at the end of the year divided by 10% gives us a price of the zero coupon bond today of 9,091 euro. So how does it work? For example, you own this bond, like this is yours. You have a bond which is valued at 9,091 today. But you're going to sell it to me, and I'm going to pay you this amount today. Why would I pay you this amount today? Because I know that once I own the bond, the underlying organization that has issued the bond is going to pay out its face value at the end of the year. So by paying you 9,091 and me receiving 10,000 after 1 year will give me exactly the yield to maturity that I require for investing in this particular market. Let's have a look at the coupon paying bond and the use of the present value equation using multiple cash flows. Now, a coupon paying bond has a specific set of terms. The term is that the owner of the bond is receiving the face value back at the end of the lifetime, which in this case is 1,000 euro. You also receive, as the owner of the bond, 5% coupon rate, which gives you a coupon payment of 50, which is equivalent to 5% times the face value. Okay? The maturity date of the underlying bond is exactly 5 years from now, and the yield to maturity in the market is 5%. In contrast to the previous example, here we have a bond that actually pays out intermediate payments of 50 per year, which is equivalent to the coupon payment. So T0 is today. The first payment is going to be at T1 and the last payment is going to be at T5. Note that at T5 the face value is also going to be included in the repayment. So remember that each bond is going to pay back its face value at the end of the maturity. And since the maturity is exactly 5 years from now, the owner of the bond will receive 1,000 euros at T5. In the next slide, I'm going to show you how to calculate the present value of these sets of cash flows. In this slide, I've shown you how to calculate the present value of a coupon paying bond that, as we've discussed in the previous slide, has a cash flow payment of 50 for 5 years. And we also need to include the face value at T5 as well as a cash flow payment. Now, here you can see the first part of the equation, which deals with the present value of only the coupon payments. Okay? This part over here. And we have a separate equation for the present value of the face value. Well, the sum of both is going to be 1000. So what does this 1000 actually mean? For example, if you would own this bond, it would be valued in the market for 1000 euro. So if I would be interested in buying your bond, I would need to pay you 1000. What do I get in return if I'm going to buy the bond? I'm going to expect the company that issued the bond to pay me 50 at T1, 50 at T2, 3, 4, and 1050 at T5. Note that I, as the new owner of the bond, receiving all these cash flows in the next 5 years, will be giving me a return or yield per year of exactly 5%. So we have discussed the pricing of a zero coupon bond, so a bond that does not pay any coupon payments but only the face value at the end of the lifetime. And we've discussed in a previous slide the value of a coupon paying bond. In this slide, I'm going to add another dimension, and that is that what happens to the price of the coupon paying bond if the desired rate or yield is not 5% but 6%. So the coupon payments remain exactly the same, regardless of changing yields in the market. The firm has promised to pay a coupon of 50 per year, including the face value at T5. So that's unchanged. The only thing that's going to change in the equation is the yield, so the 6%. It goes from 5 to 6. Well, if we fill in the new yield in the equation, we are going to have a present value of the coupon paying bond of 957 and 88 euro. So that's interesting because in the previous example, we had a required yield in the market of 5%, and the value of the bond was 1000. But now if you own the same bond but the market rate is going to be 6%, your bond has actually devalued to 957.88, which is exactly equivalent to 95.88% of the face value. Why is that? Because in the previous example, the coupon payment is 5%, but the yield is also 5%. So you would need 50, but you also get 50. So you're willing to pay 1000 for the bond. In this particular case, you need actually 60 or 6%, but you only get 50, you see? In other words, the coupon payment is actually only 5%, but you want actually a little bit more because you require 6%. But it doesn't pay you because it pays you 50. And therefore the bond, in this particular case, is trading at a discount. So what we've learned from the previous example is that the price of the bond depends on the difference between the coupon rate and the yield in the market. Here we have an example where the yield in the market is actually 4%. So not 5, not 6, but actually 4%. So if we are going to fill in the new yield in the equation, And of course, the coupon payments remain exactly the same because the company has promised us to pay 50 per year plus the face value of 1,000 back at T5. So that's, exactly the same as the previous two examples. The only thing that has changed is the 4%. So filling it in the equation, we will get to a new price of 1,044 and 52 cents. Now this is interesting because in the previous example, example number 1, we actually got 5% as a coupon payment, and we also had a yield of 5%. So in that case, we had a price of 1,000. In this particular case, we only require 4%, not 5, but 4. But we get 5%, you see? So we get more than that we require. And therefore, the price of the bond is higher than the 1,000. And that means that we have a premium bond. So what happens if the desired rate or yield is going to be 0%? What's the impact on the bond price? Well, I'm going to fill in the 0% in the equation, and the price of the bond is going to be 1,250 euro, which is equal to the sum of its cash flows. So in sum, what we learned from these exercises is that the value of, in this case, the 5-year bond at different market interest rates would follow this pattern. So at the 0% yield, the bond is trading at 12.50. If the yield is going to be 4%, the bond is trading at 1,044 and 52 cents. And if the bond is at a yield of 5%, it is trading at a price of 1,000. So if the yield is going up, it has a negative impact on the bond price. And of course the other way around, so when the yield is going down, the price of the bond goes up. So here again the two major lessons of rates going up, bond prices would fall, and if the rates go down, bond prices would rise. And here in some the last lessons that we have discussed in these set of slides. If the yield to maturity, so the required yield, is smaller than the coupon rate, so you actually would like to have a return which is smaller than what they would pay you, we're dealing with a premium bond, which makes sense, because you get more than what you would like to get in the market. If the yield is exactly the same as the coupon rate, so they pay you exactly what you would like to receive, then the price of the bond is equal to the par value, which is in this case 1,000. In the last example, when the yield to maturity, so your yield is larger than the coupon rate, so what they pay you, then obviously we're dealing with a discount bond. And finally, a note on how the yields can change in a market. Well, obviously, yields can change as a result of changing inflation expectations and also changing credit risk of the underlying firm. So, for example, if you own a bond in a firm which is having a financial issue in the market, obviously the credit risk will go up and also your yield would go up. And the other way around as well, if you own a bond in a company which has a very low financial risk, then it may happen that the credit risk actually of the particular company goes down and also your yield requirement would go down as well. So we've come to the end of this video. I hope I've been able to tell you something about the fundamentals of valuing bonds, and I hope to see you in one of my next videos. Thank you.